Good afternoon, ladies and gentlemen. I'm Yuri Bender, and it's my pleasure to welcome you to PWM's latest expert series of video interviews examining prospects for specific investment asset classes. Today we are focusing on fixed income with our special guest interviewee Eric Domergue, head of the fixed income department for third-party portfolios at Generali Investments. Firstly, we will examine the economic background. What are you expecting now from the US Federal Reserve, Eric? Is this the end of the correlation between the central banks?
Yes, in fact, since 2008, central bank in the G4 countries have been accommodative. They have provided liquidity to the overall market, and the Fed will be the only exception. So normally it should hike its rate in June or July, but right now the investors are not pricing this hike. So if you look at the interest rate future in the US, the probability of hike is at 32% in June, and 52% for July. So investors don't think that it will hike, but in fact some members of the Fed have already said that they will hike 2 or 3 times this year.
So a more aggressive Fed and dovish central banks everywhere else in Europe, in Japan too?
Yes, so the ECB has already announced some new measures, new asset purchase program on credit. On the BOG, we expect it to announce new measures in June or maybe at the next meeting. And so the Fed will be the only one to hike its rate this year. So there will be a decorrelation, while in the past, the Fed and the ECB were correlated, hiking and driving down their rates at the same time, more or less.
There's a major concern amongst investors about negative interest rates in Europe. What would that mean for bond markets?
In fact, investors are quite sceptical in general about the effectiveness of the central bank's action, and especially in Europe on inflation. If we look at some indicators that are closely monitored by the ECB, like the forward inflation swap 5-year and 5-year, it was at 170 basis points before the measures, before its asset purchase program, and now it has decreased to 143 basis points. So in fact, the ECB, which has a goal to have an inflation around 2%, is not perceived by the investor to succeed in its mandate.
Will that change now that the range of instruments being purchased is being broadened? What kind of effect will that have?
Yes, because if we look only at the sovereign market in Europe, 46% of the sovereign market in Europe is trading at negative yield, 70% in Japan, which has been accommodative since a long time. So people fear that Europe will be the next Japan. And if we look at the amount purchased by the ECB, it's quite huge. The net issuance on a monthly basis for 2016 is around 50 billion. That's to say that the market is getting thinner and thinner due to the ECB buying more than the sovereign can issue. And so people are trying to diversify their exposure by buying more illiquid assets like private placement on SMEs, European SMEs, or infrastructure bonds. But this is something new, and it has to be taken into account in your portfolio.